Hello and welcome to the Broad Investor channel. This is Amin speaking. Thank you for joining me first, let me say that. In this video we consider the 5 key factors before making any investments into a corporation stock price or share price. Okay. I myself use these 5 key factors to get a better understanding on whether to invest into the corporation that I may be interested in. So without further ado, let's get into it. First on the list is fair value. Is an estimate of the actual true value of a company. This is regardless of their current share price. The current share price is how the market values the company. That price may be inflated. For example, if we have the same t-shirt, but mine has a logo of Asda George and yours says Gucci, people are more attracted to your t-shirt because the name Gucci has a higher value. But is it fair to pay a higher price because of the Gucci name? It is the same t-shirt at the end of the day, and anything can happen to Gucci tomorrow that makes their brand worthless. Okay? So in our case, the price of a stock could be inflated due to external noise, and calculating a fair value of a stock is essential to drown out that noise. Let's go through how to calculate the fair value of a stock. Okay guys, to calculate the fair value of a stock, let's go through an example. Okay, I've already chosen this company called Essentra for this example. Now to calculate the fair value, the variables that we are interested in is EPS normalized or earnings per share normalized, the growth rate of that company, a minimum rate of return, so that would be one that we determine, a minimum safety of margin of safety, one that we determine as well, and that company's PE ratio. Okay, their EPS normalized is 21 pence, okay, not 21 pounds in this case. Their growth rate, this is per year, and it's at 9% per year. The minimum rate of return that we would like per year is 15%, as an example. Okay, and we have a really high margin of safety of about 50%. Remember, this is all estimates, so hence the error of 50%. Okay, and we've got a PE ratio of 63.9 for this company. Okay, so to calculate the fair value, we need to look at the intrinsic value of this company. So in 10 years time, how much are they going to grow? So year 1 being 2020 and year 10 being 2029. Okay, so we are going to calculate the fair value for Essentra. Okay, so let's start. So what we said is that we're interested in the EPS normalized, which is at 21 pence, and this company will grow possibly by 9% every year. So if we times 21 by 9% every year, we get to a EPS normalized of about 45p by 2029. Okay, now to calculate the current fair price of this company, we need to go backwards from 2029. So what we do is we take the EPS normalized at 45p and times that by the PE ratio. So if we were to sell this stock in 10 years time, it would be worth £29.14p. And what we want to do is to calculate backwards what the fair value should be. So we said a minimum rate of return for us is 15%. Okay, so if we go down by 15% every year, we come to a price of 828 pence. Okay, so that's the share price of 828 pence. Okay, and we will have to divide that by 50%. Okay, so the fair value for this company would be around 414p. Okay, 414 pence. Now I know currently that Essentra trades at just over £3, so we can deem this to be a fair value for this company. So they are actually under what we calculated the fair value to be. So second factor to consider is earnings momentum. In another video we spoke about the EPS. Please see the card on the top right hand side of this video. Earnings per share or EPS is really key to finding the earning momentum of a company. Now, the earning momentum is when a company's EPS growth is increasing or decreasing from the prior year. So when investing, look at the EPS growth of a company for the past few years. I typically go as far back as 2016 and have estimates of EPS growth for this year and next. So a positive earning momentum indicates an increase in the stock price over time, of course. If the earnings momentum starts to falter, the stock price may drop. Let's look at a few examples here on my sheet. When speaking about earning momentum, as stated earlier, the EPS growth is key. And what you have here is the EPS growth of these tech companies as a percentage. And like I said earlier, we are interested in historical EPS growth as well, hence why we go back as far as 2016 and estimates for this year and next. And as you can see, these tech companies have been growing nearly every year. The likes of Adobe have for the past few years and will do for this and next. Amazon in 2017 took a hit, but really bounced back the following year at a 336% increase. So since then they've been growing, as you can see, and 2021 is going to be a better year than this for Amazon. Okay, so that's EPS growth and how that relates to earning momentum. The third factor to consider is dividends. Now, if you are looking for a bit of dividends from a stock, and a lot of us are, hence why it's in this 5 key factors, it is good to look at their dividend yield. Okay, I've gone through the dividend yield in another video. Please see the top right hand corner of this video. Okay, the dividend yield provides a good indicator of how the company is performing. Okay, a too high dividend yield normally means a drop in the stock price. A dividend yield greater than 10% is really a red flag to many investors. Okay, so what a lot of growth stocks like tech companies are doing is that they don't provide a dividend to their shareholders. These companies prefer to reinvest their earnings to fund other projects. Okay, they hope these internal investments would yield higher returns. So these companies' stock price appreciates, which in the long run leads to a greater return for the investor. So as an investor, we should be looking at their historical dividend yield, and if this has been increasing over the last few years, this is a good indication that the company's earnings and revenue is increasing. Okay, this is good. The fourth factor to consider is industry performance and comparison. One of the easiest ways to choose a stock to invest into is first to determine the direction of the market, then select the top performance sector, and finally select the best stocks from within those sectors. Okay, from this graph here you can see sector comparison, giving you a broad overview of relative performance of the various sectors. This graph is the 1 year change as of the 10th of July this year, 2020. The top performing industry is tech, again after a really strong 2019. Okay, an industry that has taken a hit lately is energy, as you can see. So industry performance and comparing that stock in its industry to other stocks in that industry is really key. So that's the fourth factor. Fifth factor to consider, and probably as important as the first factor, is economic moat. Okay, this term was first coined by the man himself, Warren Buffett. Okay, this really means looking at the background of the company, not only their books but their competitive advantage. What is a company that you're researching distinct advantage? Okay, for example, the likes of Apple have a wide and numerous amount of patents for the creation of their item. Okay, Amazon has AWS. This is a software solution for web hosting. Once a company decides to use AWS, it is very unlikely the company will decide to switch. The same goes for Apple. Once people start to buy an Apple product, they are very unlikely to switch. Okay, so this is their economic moat. That is the end of the 5 factors. Okay, so remember, no amount of calculation would ever allow you to know for sure that a stock is a sure thing, especially in this current market that we're in. But these 5 factors are good tools for new investors trying to determine whether the stock is good value or not. Okay, as you get more comfortable working with these numbers, you'll be more confident choosing stocks and trying more advanced tools for evaluating companies. Thank you for joining me today. Please like, share, subscribe. It's really key for this channel to grow. I really want to get the word out there. Thank you for watching, and I'll see you in the next one.